What about gold per ounce? Where's gold trading? And is it up or down? And what's the number one, two main factors that would drive gold prices up and down? If interest rates go up, what happens to gold prices? Let's just do that first. If interest rates go up, what's the most likely scenario, all things being equal? If interest rates go up, then probably gold prices are going to go. Now, how does that work? So if interest rates are going up, does gold provide a coupon? Does gold pay a coupon or an income return? No, it's all in capital appreciation, right? So if interest rates go up, do the coupons go up as interest rates go up? My income return, does it go up with interest rates? Yes. So if I can get an interest rate, higher interest rates on bonds, and get higher yield on bonds, but basically no income return on gold, and all of my return is in capital appreciation, and interest rates go up, am I going to be buying bonds at the higher yield, or am I going to be buying gold at no income return with the possibility or probability of price appreciation in the future? Am I going to buy, as interest rates go up, am I going to buy bonds, or am I going to buy gold? Bonds or gold. Higher return, no return. Higher income return, no income return. Higher return, a promise of a price appreciation. Which one am I going to buy? Bonds. So if interest rates go up, bond prices normally go down. Okay, got it. What would cause, give me two factors that would drive gold prices up or down? Two main factors that would drive. And you should be taking notes. While recording I'm recording it, I would be taking notes. I would get actively engaged. Unless this stuff is totally innate for you, and you remember everything that I said in 123, and you remember everything from your macroeconomics class and your accounting, and you remember everything because you got a photographic memory, and you remember everything, I would probably take notes. Okay? I would probably take notes. Give me two factors that would drive gold prices up and down.
Weakening of paper currency.
Due to what? Yeah, so you're saying that as inflation and inflation expectations go up, what happens to currency values? Do they go up or down? Down, okay. And as inflation goes up, and you're watching your currency value go down, i.e. your purchasing power, what are you going to buy? What commodity, what asset class are you going to buy to hedge off the deterioration due to inflation? You're going to buy gold. So if inflation expectations, and inflation goes up, and you're seeing a devaluation, depreciation in your currency, then you're probably going to buy what? Gold, and gold prices are going to go up. Okay, got it? Gold's been traded in a trading range between basically 1,200 and 1,400 for quite some time. People are basically saying now in the marketplace, people are talking, okay, a lot these days. They're basically saying that they're a little freaked out. Okay? There's a lot of freaked out news coming down the pipe because everybody's concerned because the majority of industrialized countries over the last 10 years have basically levered up their sovereign balance sheets and have issued tons of sovereign bonds. Okay? Issued tons of sovereign bonds. And the debt to GDP ratios for a lot of these countries are in the 100, 150, 250, and 300 times. So their debt loads are 3 times the GDP, their annual GDP. Is that concerning? Absolutely. Because what happens if we go into a global recession, which we are probably on our way to, because Germany last quarter had a negative GDP. If you do negative GDP in 2 quarters, that's a recession. Italy's already in a recession. Spain's in a recession. Argentina's in a recession. Brazil's in a recession. Japan has been in a recession for like 20-something years. And actually China looks like it's probably in a recession too, although they fudge the numbers and we never really know. unless you looked at the import-export numbers and the capital flows, FDI going in and out of the place. Okay. So again, tell me about gold. Yeah, let's get back to gold. So two factors that would drive gold prices up and down. One is inflation expectations, excellent. And what's the other one? If I was living in Venezuela over the last 3 years, would I be investing in stocks and bonds, Venezuelan stocks and bonds? What would I be investing in? Gold. And what would be the main driver other than inflation that would drive investors into gold, particularly Venezuelan investors? What's the biggest risk down there? What's the biggest risk in Venezuela? What's happened? What just happened down there? Anybody follow these markets?
There was a communist revolution that took a lot of money from the upper classes.
Yeah, there was definitely a rightward shift or leftward shift under Maduro, and then the current president was just they just had a major presidential election. The presidency there was two. There was basically U.S. backed, and then there was Maduro. Maduro doesn't want to doesn't want to give up his power. He's basically has had total, political, economic chaos down there, inability to manage the economy. So what kind of risk is that when you have political leaders that are basically driving your economy and your country into geopolitical morass? Geopolitical risk. Geopolitical risk. So it's basically inflation expectations, inflation, and geopolitical risk will drive demand for gold and drive gold prices up and down. Also, to a less degree, central banks like to hold gold in reserve to anchor their currencies so that they don't totally depreciate or devalue based on hyperinflation, because most governments like to print the printing press, create inflation to try to maintain unemployment and living standards, but they can only do it for a short period of time. So the purchasing and holding or unloading of gold reserves by central banks and treasuries will have an impact on the market, but it's just transitory, it's not fundamental. So really the two main factors that would drive demand for gold and gold prices up and down is inflation, inflation expectations, and geopolitical risk. Okay. Did you have a question?
Yeah, I was just gonna ask, when interest rates rise, when a recession kicks in?
No, they don't.
What?
Interest rates do not go up during a recession.
So when a central bank, lowers interest rates,
Yes.
that's why, that's a direct relationship with the rise in gold, or does that come from
No,
weakening of the dollar?
Gold is just a transitory, it's just a mechanism to hedge off inflation risk and to hedge off geopolitical risk. When the Federal Reserve sees that the economy is going to be going into a recession, based on their forecasts of GDP and inflation, future inflation, if they think we're going to be going into a slowdown or into a decline or a trough in the business cycle, and they know that inflation expectations are going to go down, they're going to start driving interest rates down and try to stimulate the economy. Remember the Fisher equation? Fisher equation, real rates plus inflation expectations equals nominal interest rates. So as inflation expectations fall, nominal interest rates fall. Real rates will have an impact, but real rates are secular in their movement up and down. It's inflation and inflation expectations that drive interest rates up and down. We're doing basically a crash course, a review course here right now. And a lot of you should all have already remembered and heard about this. Okay, let's talk about bonds then. Where's the 10-year treasury yielding right now? Do we care about the 10-year treasury yield? Yeah, because basically all rates, all lending rates are tied to the 10-year treasury. So the 10-year treasury is the base rate, and then you start tacking on risk premiums, credit default, liquidity, those things to get to the rate. So if you're a student and you want to borrow student loan, you're going to start with the 10-year treasury, and then they're going to slap on basically an illiquidity premium, a maturity risk premium, and a credit default risk premium directly tied to your credit score, and directly tied to you as the creditor who's basically borrowing the money. Okay, so there's a spread always over the 10-year treasury. Could be student loans, car loans, mortgages, everything is priced off of the 10-year treasury. So where is the 10-year treasury yielding today? 2.68. And where was it trading yesterday? So it's now either up or down to 2.68. Is it up or down? Where was it yesterday? And then where was it 2 years ago or a year ago?
It closed at 2.661 yesterday.
2.661, and it's at 2.68 today. So the yields have gone up, right? So there's two, I'm just going to tell you, so there's two reasons why bond yields have gone up. Bond yields went up because bond prices went what? It's a test. So bond yields went up because bond prices went up or down. Bond yields went up because bond prices went up or down. Down. Got it. You guys, you need to know this. This is going to be in your interview. Okay. You can't get a career in finance if you don't know this stuff. Okay. It's just a fact. So yields went up because prices went down. So was there more or less supply in the marketplace? Was there more supply or less supply that caused prices to go down? Was there more or less supply? More supply. More supply caused prices to go down, that caused interest rates to go up. Got it. Okay. So why was there more supply? What happened over the last 24 hours that would cause the supply of bonds to go up? Prices to go down and yields to go up. We just talked about it maybe 10 minutes ago. People are selling off bonds and they're buying what? And bonds are a safe investment. So if they're selling off bonds, they're buying what? What are they buying? Remember, there's trillions and trillions and trillions of dollars that are flowing through the economy, 24 hours a day, 7 days a week, every single day. So if there's trillions and trillions and trillions of dollars moving around in the world constantly, if people are selling bonds, they're probably buying what? Stocks. And what did stock prices do? They went up. Okay, so everything is related to each other, okay, in one way or another. Based on the Fisher equation, what's the Fisher equation? Nominal interest rates equal what? What are the two factors in the Fisher equation? Again, you can look it up. You can type it up. You need any help?
What?
You need any help?
Well, like, I haven't gotten the previous classes, so.
That's okay, because you can just get online.
Yeah,
Just
yeah.
type in the Fisher equation. I just want to see interaction because it's easy just to sit back and let everybody do all the work. But this class is an applied class. It's totally hands-on. Everybody's got to be working to find the answer.
Yeah.
So what are the two factors in the Fisher equation that drive nominal interest rates up and down? The first one is real rates. The second is inflation expectations. Got it. So if yields are going up, what's happening to real rates potentially? Are they going up or down? Based on the Fisher equation, it determines nominal interest rates. The yields on the 10-year treasury just went up over the last 24 hours. Then the real rate probably did what? Either went up or down. What did it do? It's a linear equation. Okay, there's no exponentials on those things. So if real rates, did real rates go up or down? If yields went up? Based on the Fisher equation. Write the Fisher equation out. Okay, say it. Up, and just yell it next time. Okay? Okay, but remember, real rates are cyclical, so they don't move a lot. What's the number one factor that drives interest rates up and down using the Fisher equation? Inflation expectations. So if the 10-year treasury yield went up over the last 24 hours, what did inflation expectations do? They went up. Got it. It's a game, okay? That's all the world is a game. You go to school to study the rules of the game, okay? There's rules of economics, there's rules of finance, okay? We're just like the sciences, we're like physics and stuff like that. We have rules, we have game rules, we have logic, we have theory, in which the whole thing is predicated on, okay? All the traders, all the investment bankers, all the equity analysts, all the fixed income analysts, they know all of this stuff. Up, down, up, down, up, down, okay? And you gotta be able to make decisions very quickly, and you gotta know the decisions that you're making are correct. If you're confused, you need to study, okay? And make sure that when you do make that decision, it's based on data, and it's based on science, and it's based on logic, and it's based on theory, and know that when you make the decision, you know it's the right decision, and then you act decisively, okay? And you build a reputation to do that. Okay, what about the US dollar? US dollar to the euro. US dollar to the pound. How much is it gonna cost me? If I wanna buy a pound or a euro a pound, how much is it gonna cost me?
1.28
For the pound, okay. So it's 1.28. Where was it yesterday or a week ago? So it's gonna cost me 1.28 right now, $1.28 to buy the pound. And the pound's tough, right? Because what's the euro? When I look at the pound in the UK and I look at the euro in the EU, what do I see? What's the difference between the two? What's the difference between the UK and the pound in the EU and the euro? Is there a difference between the two? What's the difference? Well, we know that, but give me a institutional analysis of the two. What's the geopolitical institutional arrangements in the EU compared to the UK? Is there a difference? Yeah, what is it? Go ahead.
EU is a unified group
Of,
countries,
exactly. And what's the UK?
just one country.
You got it. So which one is going to be more stable?
Well, it's three countries.
Huh?
It's three countries, the UK.
Yeah, but it's not 8, right? And but they're fairly homogeneous while the EU is very diversified, right? So the volatility in the pound compared to the euro, which one do you think is going to be more risky and more volatile? The euro or the pound? Really? What's happened over the last 2 years in the UK? Brexit. Is that going to create volatility?
Yeah.
Yeah. Did they get the deal done? No. When are they supposed to have the deal done by? March, right? So they've been working on it for 2 years. They can't get it done. What if there's a hard Brexit? What's that going to happen to the value of the pound? It's going to go down. What's going to happen to the value of the dollar? It's going to go up, right? So there's risk, right? So how much did it cost me to buy a pound 2 years ago, or right after they announced the Brexit? Do you think it cost me more or less? Right after the Brexit, what happened to the pound, the value of the pound? It dropped by about how much? 6, 8, maybe 10%. So what did that do to the dollar? If the pound goes down 10%, devalues or depreciates 10%, what happens to the value of the dollar? It depreciates by 10%. Let's just say all things being equal. So when it costs me more to buy a pound or a euro, let's say it now costs me more to buy a pound or a euro compared to last week. It now costs me more. Did the dollar appreciate or depreciate? If it cost me more to buy the pound or the euro, did the dollar appreciate or depreciate? Depreciated. And what about the euro and the pound? Did it appreciate or depreciate against the dollar? Appreciated. Okay, you guys got it. Okay, awesome. So that's kind of it. Okay, that's kind of the exercise. Every day you come in, we want to work through these markets really quickly. We want to track the markets. We want to figure out what's going in the markets, but we can't spend a lot of time on it. But we need to know what's going on in the marketplaces so I can train you on the logic. Okay, and then you're going to be doing those memos again. Okay, remember those memos, Justin? I know how much you love those memos. And I know Paul loved those too, Samantha, and everybody. Love those memos. We got a couple people that shook their head, don't like the memos. If I don't have the memos, if I don't use the memos, do the memos train you on basically economic logic and the factors that drive the prices of the different asset classes? Does it? Yeah. Okay. So there's one value to it. Are you going to be studying derivative contracts in this class, even though you studied derivative contracts and I trained you on derivative contract trading in 123? Are you going to be learning about derivatives? You already know the logic behind derivatives, right? Yeah. If prices go up, what are you going to do for the, if you think the index values and the prices are going to go up, what are you going to do? What are your index trades? You're going to buy what? Come on, you should remember this. This was memorized into you. This was drilled into your head last semester. Take pictures of these memos. If I think that the prices of gold are going to go up, and I identify a gold index, okay, and I think prices of gold are going to go up, is the index value going to go up? Say it. Yes. So if I'm forecasting gold prices to go up, I know the gold price indexes are going to go up, either spot or what's the other type of index? Spot or futures price indexes. So if I think that the indexes are going to go up, what are my derivative trades? What are the derivative trades? You still have your memos from a year ago, 2 years ago. You might want to break them out and you might want to look at them. You're going to buy what on the indexes? I think the prices in the indexes going to go up. I'm going to buy what? Are we to counter contracts such as, no? What are you going to buy? I think the gold prices are going to go up and the gold price indexes are going to go up. What would be my derivative trades on the indexes? Remember we went through this. Pull out your memos. Pull out your memos. Go get your memos. Oh, you already asked. Okay, what's the trades on the indexes? For those who haven't taken the class, this is a critical juncture for you. You need to be writing these notes because we're going to go over this over and over and over again. This is your first exposure to it. So it might be a little overwhelming, but you're going to totally get it, okay? You're going to totally get it. So you're going to buy what? Forwards, and then you're going to buy what? No, the next one you're going to buy? Futures, and then you're going to buy calls on futures, and then you're going to do right puts on futures. Can I buy gold company exchange traded funds? Can I buy gold company exchange traded funds? Can I buy gold company exchange traded funds? Can I go online to Vanguard, Schwab, BlackRock, and find gold company exchange traded funds? Can I do that? Yes, I can. And if I think that gold prices are going to go up, what do you think gold company stock prices are going to do? If gold goes up, what happens to the revenue for gold companies that are selling gold into the market? They're going to go up. And what's going to happen to their earnings? They're going to go up. What's going to happen to the stock price? So if I forecast that gold prices are going to go up, couldn't I buy gold company exchange traded funds? How else can I buy them if I want to leverage up my position? I could just buy the shares, or I could buy gold. No, I don't want to buy gold. I want to leverage. I got $100 million bucks, and I don't want to buy $100 million of gold ETFs. I want to leverage my position because they're really smart. We know how to do the forecasts. So what would be my trade? One, I could buy, but I could also buy a margin. So I could basically, I have $100 million bucks, and I basically borrow another $100 million bucks. So now I'm controlling $200 million. I got about 50% of my position in margin. Okay, so I borrow that, and if I'm right, my return on equity is going to go through the roof because now I have $200 million position instead of a $100 million position. So I'm using leverage, so I can buy on margin. How else could I leverage my position? By using derivative contracts. If I think the price of gold is going to go up, and ETF company shares are going to go up. What other derivative position? I could do what? I buy call options. And I could do what? And I could write puts. Okay. Can I buy the individual company, gold company stock? Can I buy the individual gold company stock if I think gold prices are going to go up? Could I do that? Well, what if I want to leverage my position? What would be my trade? I'd buy a margin. And what would be my next trade? I'd buy calls, and I would then write puts. Okay. So I'll go through some of this stuff. But that was kind of your crash course, okay, in the memos. So the memos are extremely important tools to communicate your competency and your capabilities to forecast these markets, and then to be able to tell us what are the factors that are driving the prices up and down, and then how are you going to apply these trades to basically make money or hedge your position, and then give me the data. Give me the data within the memos to substantiate your forecast, along with the graphs, to reflect the technical analysis that you've conducted along with the fundamental analysis, and then give it to me again at the end of the memo, and do it for the 5. So a lot of you have done this before. For those of you who haven't done this before, you need to train these people, okay? You need to work with the students that haven't taken the 123 to bring them up to speed very quickly and work with them, because I'm only one person. I will do it. You can come to my office. I will spend time with you. I will work with you on this. But you get in your teams and have your team members and make sure your team is not all people that didn't take my 123 or 136 or 135 class, okay? Because we're leveraging, all right? So you're going to leverage others that have taken my classes before in the past to get up to speed very rapidly, okay? For those of you who have taken my classes in the past, you are now going to leverage off of the solid foundation of economic and finance theory and do a lot of the stuff that you've done before in the past, but new stuff too, okay? So you need to go back and review some of this stuff, okay? Don't take it for granted. They're going to expect you to remember everything that you've seen, everything that you've learned. They're going to expect that you know everything when they hire you, okay? And if you can get through the interviewing process by communicating your competencies, you're going to increase your probability of getting hired, okay? And that's all my goal is to give you a comparative advantage. All right, so that was pretty intense. So let's do the introductions really quickly, okay? Elevator pitch. Do you know what an elevator pitch is? What? What's an elevator pitch? Why is it valuable? Why do you use it? Why do you want it? Why do you want to perfect it? Do you have a question? Megan, does he have a question? What's your name? I'm sorry.
Nick.
Nick, did you have a question?
No, sir.
Okay, cool. So why would you want to have a perfected elevator pitch?
If you run into a potential employer, you want to be able to make that pitch to
Totally.
get a job.
And how long does it take to give an elevator pitch?
30 seconds.
Exactly. Okay. So they know exactly what you're doing, and you have to sell yourself, because you never know who you're going to meet at any time. You're going to be in an elevator downtown 101 San Francisco. There's freaking Charles Schwab, okay? You know, or some other person. You never know. They may say hi to you. You strike up a conversation. Before you know it, you find out that they went to St. Mary's. They studied business. They were a finance major. You know, they actually work at BlackRock where you want to work. All of a sudden, you create an instantaneous relationship. You come off well, and before you know it, you got an informational interview or an interview. Does stuff just happen like that, randomly? Yeah. You're just creating opportunity by perfecting your pitch. So give me your elevator pitch. Give me your name, school, your major, concentration, graduation date, the company you want, not like to, or I wish, I want to work for, and the position you want. Because if you can tell people what you want, they will give you what you want. It doesn't really matter in this world when you get what you want, it's just that you get what you want, okay? Especially when it comes to a career, and a family, and those things. If you want that, you need to communicate that to people, and they will help you get what you want. If you can't ask, you can't tell them, they're not gonna do it. They can't read your brain, they can't read your mind, and Apple has to come up with an iPhone that reads people's minds. Okay, until they do, we're gonna have to tell people what to do. So go ahead.
All right, my name is Drew Mitchell. If you can't tell, I go to St. Mary's College.
No, just imagine that you're doing an elevator pitch.
Like straight on.
Yeah, you're pitching us, because your network is your net worth.
Okay.
So if you can convince these people, they may hear about a lead or something, and then they'll refer you over the lead, and who knows, you may get the job sooner than you think.
Got it. My name is Drew Mitchell. I go to St. Mary's College, California. I'm a business administration major. I'm focusing or concentrating in both business analytics and finance. I'll be graduating in June 2020. I want to work for BlackRock down in San Francisco. And what I want to do is I want to pick up a data scientist position in one of their many different departments.
That was good. By the time we get to these guys back there, they're gonna be nailing it. You just need to clean it up a little bit.
Yeah.
But it was really good. Nice, you hit on all the key points. Nice job.
My name is Bobby Purdy.
And try to get a little eye contact.
Okay. My name is Bobby Purdy. I go to St. Mary's. I'm a business major. I'm graduating in December of 2018. I want to work for MAH01494 as a
Nice, next.
Hi, my name's Connor
And use the
Thane.
position.
Hi, my name's Connor Thane. I go to St. Mary's College of California. I'm getting my Bachelor's of Science in Business Administration with concentrations in Finance and Business Analytics. I graduated in May 2019, and I would like to work for Zillow.
Yep.
I want to work for Zillow for the rotational position.
Yeah, those guys are good. Those guys are good.
My name is Kyle Clark. I'm from St. Mary's College of California. My major is business with concentration in finance. My graduation is May 2019. I want to work for the NBL, which is the National Basketball League in Australia, as a financial manager.
Oh, that's awesome.
I'm Kevin Haanen. I'm a senior here at St. Mary's. I graduate in June of 2019, and I want to work for Columbia Records as a talent manager.
Yeah, that's fantastic.
I'm Justin Schrager. I'm a senior at St. Mary's College of California. I graduated in May of 2019. I'm a finance major, and I would like to be a
No, no.
financial. I want to be a financial analyst at Salesforce.
Excellent.
My name is Paul Versteeg. I go to St. Mary's College of California. I'm studying business finance. Graduating May of 2019, and I want to work for JP Morgan as a financial analyst.
Excellent.
My name is Samantha Turpin. I'm a student at St. Mary's College of California, majoring in business administration with a concentration in finance. I'm graduating May of 2019, and I want to work for Schwab as a financial analyst.
Did you know that we're going to get George Pereira, who's the CFO of Charles Schwab Investment Management that I worked with for 3 years, to come speak here on campus, hopefully on May 1st. I can introduce you to him.
My name is Brandon Lim. I go to St. Mary's College of California. I'm a business major with a general concentration. I'll graduate in the fall of 2020, and I want to work for Genentech as a corporate development.
So everybody's going to need to convince him to change his major from a general to finance.
Hi, my name is Bianca Morales. I'm a St. Mary's student. My major is business administration with a concentration in finance. I'm set to graduate on May 2020. I want to work at Schwab as well as a financial manager.
Excellent. I would try to imagine that you're at a cocktail party or an event or something. You need to speak up and you need to project, okay? The enthusiasm and get them excited, okay? So this is the practice, okay?
Hello, my name is Daniel Houston. I'm currently a business major at St. Mary's College with a concentration in finance and international business. I'm set to graduate on May 2020 in the spring, and I want to work as a financial analyst with Wells Fargo.
Excellent. Nice.
My name is Guillem Pedrerol. I'm from Barcelona and I'm studying in La Salle, Barcelona. I'm majoring in business, however I don't have a concentration. My graduation date is on 2020 June. I want to work for myself because I want to have my own company related with education, and therefore I want to be the CEO of my own company.
Would you take a job with somebody else?
Yes, to learn, but I still don't know where I want to be.
And if you could work for any company in any position, what would that be?
Probably something that I really like, and I have one in Barcelona that I really like for the moment, that it's global, and I think it might be a good experience.
And what's the company called?
Global.
Global. And what's the position?
Probably just operations, if I could.
Okay, I'll take it. I got it out of him. Okay.
My name is Jamie Arias. I go to St. Mary's College. My major is business with concentration in finance. My graduation date is June 2020. And the company I would like to work for is...
Like?
I was work for it is Bank of America as a financial advisor.
Okay, excellent.
My name is Megan and I go to St. Mary's College of California. I'm a business major
Remember, you're pitching me, right?
with a concentration in finance and marketing. I am set to graduate May 2020 and I want to work for Morgan Stanley as a financial advisor.
Oh, nice. That's awesome.
Hello everyone, I'm Nick Lauren. I go to St. Mary's College of California. I'm a business finance major. I'm set to graduate in May 2020, and the company I want to work for is the United States Air Force as a Special Forces pilot.
Love it.
My name is Bronwyn Lane. I'm a student at St. Mary's College of California. I'm a business administration major with concentration in finance, and I'll be graduating in the spring of 2020. I've been working for Wells Fargo for the past 2 years, and upon graduating, I want to continue with the company as a financial advisor.
Excellent.
Okay, my name is Cortland. I attend St. Mary's College of California. I'm a dual major in business with a concentration in finance and an accounting major. I am set to graduate in May of 2021. The company I want to work for is Carl Smith Ball, LLC, so it's a law firm, and I hope to be a tax attorney.
Nice. Awesome.
My name's Angelina Healy. I attend St. Mary's College of California. My major is business. I'm concentrating in finance and marketing. My graduation date is June 2020, and the company I want to work for is Wells Fargo as a financial analyst.
Nice job.
My name's Carly Forgrave. I go to St. Mary's College of California. I'm majoring in business administration with a concentration in finance and global business, where I will be graduating in spring of 2020. I would like to work for CBS as a financial advisor.
Nice.
My name is Emilio Osmeña. I go to St. Mary's College of California. I major in business with a concentration in finance, and I graduate May 2020, and I'd like to work as a financial analyst at Goldman Sachs.
Excellent. Me too.
My name is Max Granger. I go to St. Mary's College of California. I am majoring in business administration with concentrations in finance and data analytics. I'll be graduating in the spring of 2020. I want to become a military intelligence officer in the United States Army.
Nice. Awesome.
My name is Emma Cassette. I go to St. Mary's College of California. I'm a business administration major with a concentration in finance. My graduation date is June 2020, and I want to work for New York Life as an executive partner.
Oh, that's awesome. You know, I'm working with Victor Vaughn. Do you know Victor Vaughn? Victor Vaughn was the managing partner of New York Life. He built the San Francisco, San Mateo, and San Jose offices. If you want to meet him sometime. He's retired now, but he's a pretty amazing person.
I just got an internship there.
Did you? Congratulations. It's a great company. I worked there for 5 years.
My name's Wes Solon. I'm at St. Mary's College of California. I'm a business finance major with an econ minor. I'm going to be graduating in May of 2020, and my dream job is financial analyst at Morgan Stanley Long Beach.
Excellent.
My name is Nathaniel Panis. I currently attend St. Mary's College of California. My major is business administration with a concentration in finance and entrepreneurship. I graduated in May 2019, and I want to be the CEO of my own record label.
Awesome. Excellent. Well, congratulations, everybody. Who's graduating? Who are the seniors? Do you guys all have jobs? Do you guys have jobs? Do you want jobs? You need to be working with me and Mary Beth like now with your resume and your pitches and everything. We have jobs. We have too many jobs. We have too much jobs, but a lot of our students don't reply. They don't apply. They don't reply. It's amazing. We have more supply than we have demand. Okay, we don't understand it, but if you work with us, we will help you get placed. Okay, and then who's not graduating? Do you have your internship set up for next summer? Has everybody got their internships that aren't? Do you have an internship? Is there a yes or no? No? Should you? Yes. So should you be working with me and Mary Beth to get you placed in an internship for the summer? Now? Yeah, because they were hiring last semester in the first month for this summer. Okay, so we're already late. All right. And then for those of you who are further out, you got to get internships and you got to get your jobs nailed down as soon as possible. Because the two factors that are the biggest thing, because I went and talked to a bunch of the graduates over the last 2 years, and the two things that they said were the most stressful for them upon graduation was not having a job and not having a place to live. They said, well, let's help you get a job. I can't help you find a place to live, but if you can get your job and a place to live done now, within the next month or two, you're going to sail through graduation and you're not going to be stressed And if you leave the university after you've graduated, it becomes really hard to use the resources here to be able to leverage, because you're not going to be on campus, you're probably going to be doing something else. So use the resources available to you now to leverage your position and get engaged. Okay. Most of you are seniors. In my 123, they're juniors. Some of the juniors, I would say a third to 25% of the juniors are still stuck in this academic mindset. They're looking backwards in the last 14 years of their existence. They're basically post-adolescents. They don't look at themselves as adults moving towards the adult world, moving towards their career. Those days are over. You need to focus on the present, and you need to focus on the future. That was fun. This is now, fun is over. You need to focus on your career and get a great career so you can take care of yourself and your family. Okay? So that's my little pitches. The statistical pretest is exactly the same, okay, as the 135, although 135, which is global, I twisted it into a global statistical pretest. The statistical pretest, this is an advanced course, okay? This is an advanced course, okay? This is an advanced course. So for those of you who have not taken 123 with me, you need to work with us, okay, who have, to get you up to speed very quickly, okay? The way that it should be is that 123 should be the prerequisite for 135 and 136. You shouldn't take them simultaneously, you should take them in order. You should take 123 first, and then 136 and 135. So you have a solid foundation going in. If you take in 123, 136, and 135 simultaneously, or in the reverse order, you're not going to get the solid foundation to be able to build on. So you guys are going to have to get up to speed a little bit quicker, but we'll help you. Okay? And it looks like you get a lot of it, because I can see that you're shaking your head a lot. Okay? So you'll get a lot of it. The nuance here is that the pretest in 123, the pretest in 136, the pretest in 136 is the pretest from 123 plus the quiz. So the pretest here is the pretest and the quiz. So you have to take the quiz over again. Okay? Why would I make you take the quiz over again? Why would I make you take the quiz over again? Why would I make you take the quiz over again?
It's important.
What?
It's important.
And give me some feedback. Why would I make you take the quiz over again?
To understand the material better?
Exactly. Is it going to hurt you to be able to do stuff over again so that you basically learn the material in and out through reinforcement? Will you be learning stuff over and over again in your career? And if you learn stuff, you're going to be a fighter pilot. Are you going to learn stuff over and over again? And if you learn stuff over and over again and you become completely competent, what happens when you get into a situation where you need to act decisively?
It's natural.
Exactly. It becomes natural. You're going to be in a meeting. You're going to be talking about the asset classes. You're going to be talking about valuations. If you get your theory wrong, you're going to totally discredit yourself in the meeting. Okay? So the precision of your logic, the precision of your language, the precision of your communications is so critical when you get out there, particularly in the interviewing process, and when you get out there as a professional, they're going to expect it. Okay? So reinforcement, reinforcement, reinforcement. I got like one student that said, oh, you know, it's just like 123, we're learning the same stuff over again. Really? Are you learning it over again, or are you reinforcing the material so that it becomes second nature? So that when you're confronted in a situation, you know exactly what to say, you know exactly what to do. Okay, go ahead.
Oh, you just need two more.
Okay. All right. And I'll go over some of that stuff with you. I'll go over it with you. Make an attempt at it. Okay? Make an attempt and see how much you did. I know where you're going to be weak. You're going to be weak in the modern portfolio piece because everybody falls down in that piece. You're going to be weak in the technical analysis piece. Everybody is weak on that. If you already have your material left in the 123, use it. Okay? Use it. And then let me take a look at it and see what it looks like. Yeah.
We get enough.
Okay, cool. How many do you need? Okay. And I'll go over it too. And again, it's the fundamental theoretical foundation of the work that we're going to do. This This class is going to be less theoretical and more hands-on, more application-oriented. The students need the book, okay? I don't need the book, but the students need the book, okay? They like the structure of the book. They like tangibility. Students are not comfortable yet with the chaotic or the baroque aspects associated with working in the real world, although that's what I will be simulating in this class. The book is a Bible. The Bodie and Marcus book is the Bible for the CFA exam. Okay, it's one of the Bibles. All right, it's a really good book. I will be hitting on some parts of the book. You will be breaking up in teams of 3, and you will be assigned chapters that you will present every Thursday. So Thursdays will be problem days and presentation days. You will be doing problems. I will give you problems out from the book a week in advance. I will give you the answers. So you can go study the problems and the answers and then come back in class on Thursdays. And the first thing you do is you go to the board and you start writing the problems up on the board to then present to the class. And then we will have 2 presenters, 2 teams that will present a chapter each. And what I would do is I would pull down the chapters, I would study the chapters, I would edit the chapters down to make them concise, and come in and do a 25 minute presentation on the book. Same thing we're doing in 123. So you're writing, you're doing analytics, you're doing memos, you're doing pitch books, you're doing presentations. Do you do that stuff in the real world?
Yes.
Yes. Okay. Do you guys do study for an exam and do a multiple choice exam and then get graded and then move on in the real world? Then why do they teach you that way? Why do they teach you that way? They're not teaching you real business applications in a simulated environment in the real world. What would you rather have? Academic environment or real world environment? Real world. It'll make the transition so much easier, and it will give you a comparative advantage in the interviewing process. It'll make your transition into the career so much smoother. It'll be easy for you. Okay, that's why I designed it. So this is the book. I wrote the quiz. The quiz is take home. The midterms take home. The finals take home. It's basically a bunch of questions that have been taken from the book. It's chronological. As you read the book, you fill out the questions. So you're going through it. I've never been a big proponent of here's what you need to study for the exam. Here are some sample questions, if any. Here's the stuff you need to study. Come in, take the exam, and see how you do. I've always gotten more out of take-home exams. Working through the material on my time, working through reading it, figuring it out, going through. It's like a little puzzle. And then the midterm and the final, they actually get easier because I bring in the content from the book with basically some areas of questions. So I'm actually using it as a learning tool at the end. Okay. So the first one's a little bit harder, and then it gets easier. Okay. We've got the pre-test. We've got the memos. We may be able to do the. We may have time. I don't know yet to do evaluation on a stock. I may, if you really want to do this, and you need to try to keep that camera on. Okay. If you really want to do this, I will have you pick a company or a financial institution, and I will work with you to do the valuation. You say you want to go work for Wells Fargo, do Wells Fargo. Right? You want to work at B of A, do B of A. You want to go do Goldman Sachs, do Goldman Sachs. You might have already done Goldman Sachs last semester, so you just need to update it. Okay? If you want to do that, we can do that. Okay? Most of you have already gone through this. This is an extremely valuable instrument that you can show a potential employer that you know how to produce a professional deck or a pitch book, okay? Along with the memos, along with the other stuff we're going to do in the class. Okay? The class is application oriented. It's taken me almost 3 years to develop this class. The first 2 semesters I did the class, that's all we did was build the models. That's all we did was build the models. We didn't do anything else but build models that you're going to use. So your predecessors from the courses have basically invented and innovated financial analytical product for you to use. which is amazing, okay? And I might even have some of the students from the prior semester of investments come in on Tuesdays, which is gonna be lab day. Lab days, you're gonna be working on the projects, okay? Working on projects, Tuesdays, maybe a little Larry lecture presentation, Tuesdays. Thursdays, we're doing problems and we're doing presentations. So it's all application. It's not Professor Souza gets up here for 3 hours a week, basically running through 100 slides, hoping to God that you will obtain and retain at least 10% of the content that I present to you. And then try to test you on it in a multiple choice exam or a 4-problem exam 3 times during the semester and hope that you learn finance by the time you're done. Okay? That's not the way it's going to work. Okay? I'm going to work as the managing director. We're going to have multiple teams. I'm going to come around most of the time. I'm going to be assessing you, working with you, guiding you, giving you input on the projects. You're going to need to delegate these projects to people within your team, and you're going to need to work on them when you're here in the class. Okay? I had a couple students, you know, over the last couple semesters. One was like, she was buying shoes or accessories during the class while the other students were doing the work. One guy was watching his rugby game that he had played in, you know, the week before. I mean, you're just wasting your time, you're wasting our time doing that stuff. In the real world, we're working in teams, we're working on the projects, we're putting packages together, we're doing the communications, we're writing the report, we're putting the PowerPoint together, we're making the presentations, we're moving on and doing it again. And the projects within the course build on each other. They build on each other, okay? So by the end of the class, I don't know if I brought any of the, I did. Here's your final presentation. You can take a look at it. You can pass it around. Here are some examples of some of the decks. The final presentations, you're going to be giving me multiple deliverables, but this is going to be the final report at the end, along with the presentation. So this is basically the trading system, the portfolio trading system that you're going to develop. It's total hands-on, it's total application. You're going to build a passive portfolio first, using the spreadsheet that I've developed. Then you're going to take the, I basically spent almost a month re-engineering the Excel spreadsheet from the Excel that was provided here in the Bodie, Kane, and Marcus. And what we're going to do is we're going to do the quadratic optimization, which would be mathematics behind the portfolio optimization, was by Harry Markowitz, who basically won the Nobel Prize that built the mathematics behind the Excel optimization engine. Okay, and we're going to do that. And we're going to trace out the efficient frontier, and we're going to make recommendations of portfolios along the efficient frontier to our clients. Basically, I am the managing director and president of Derivative Trading Corporation. You guys are managing directors and associate directors of the corporation. We basically develop product. We build single account portfolio strategies for institutional clients accredited and ultra high net worth. We build active trading strategies and portfolios for our clients. We take the passive portfolio strategies, we create exchange traded funds and mutual funds from it. We can use these products to basically sell under our brand, DTC brand, these portfolio strategies as products, okay, in strategies to either the retail or institutional clients and get multi-billion dollars under management. And if we can charge 100 to 250 basis points based on these strategies, we are generating $200 million a year in fee revenue. Does that sound crazy to you? Does it? That we're managing a $20 billion portfolio and we're making $200 million a year? Do you think Goldman Sachs does that? Do you think the hedge fund guys do that stuff? Do you think B of A, Wells Fargo, all of those guys, do you think that they do that? That they build product to distribute to institutional retail clients to get multi-billions of dollars under management, to be able to gain hundreds of millions of dollars in fee revenue, and then pay you $1 million a year plus bonus? Do you think they do that? Yeah, they do. And where do they do it? In New York, in Chicago, in London, and other places like that. So why can't I teach you the exact same stuff that's being taught at the Ivy League at MIT and Harvard and NYU and Columbia? Why can't I do that here? because our students are different. Our students are special. No, you're not. You're just as smart as they are. You just haven't been trained in the same methodology, the same way, the same models that they're learning from. You can compete against them. You're just as smart as they are. It's just a different environment. It's how you're taught. Okay? And if you guys got a problem with the way I teach, then I'm more than happy to go back to multiple choice exams 3 times during the semester, which is special assessments, and I just, however you perform, you perform. So what do you want to do? Old way or new way? Excellent. I only have one person actually say anything, so if this goes wrong and we don't have a good semester, it's all your fault. No, thank you for that. I appreciate that. Okay, so let's get into it. Let's go to the course website, because all the applications are up there. How much time do I have?
25 minutes.
Okay, I can do it. Okay, so the first thing, we already talked about the syllabus, the statistical pre-test. Here's some notes right here for the statistical pre-test. Here's all the supplemental materials there. Okay, so here's your calculator menus. Here's the trading systems. What I'm going to do too is I cut a deal. I cut a deal with the Chicago Mercantile Exchange, the CME group. I talked to the CME group. They said that they would set up a platform for us to trade derivatives off of their platform. Okay, so you're building portfolios and you're trading derivatives. Okay, so I will do a Zoom room thing. I will have them come up and walk us through it, they'll train us, and we'll start applying some of the stuff that we're learning in a real live environment. So you go in for the interview and they say, well, what have you done? Well, we build active and passive portfolios. Here's some examples. Here's the performance of the portfolios. Oh, and here's a track record of my derivative trading strategies that I developed over the last semester. Are you going to get the job? Yeah, because Cal Poly doesn't do that stuff, and the Cal people don't even do that stuff. Okay, so there's all the sites right there, but I've already put up the CME stuff. Here's the worksheet right here. You need to pull that up. So there's going to be, you go down here. Oh wait, I'm in the wrong one. EB 136, sorry about that. So here's the log, got it. So that's an example of that. Here's the course logs from prior, there's the syllabus, BAMP right here. Here's the statistical pre-test with supplemental materials. Right here, portfolio analytics, Excel spreadsheets. Okay. So basically, we're going to be working with all of these right here. So this is it. You need to understand something. You cannot bring these Excel spreadsheets up and share them in Google. You'll blow them up. Okay. So when you trade off from one person to the other to work on it, use it in Microsoft 365, okay? But make sure you shut it down and make sure you're working in a Microsoft environment, okay? Especially the optimization, because there's macros in there. And if you share it, you're gonna blow it up. 2 of my students blew it up over the last 2 semesters, were screaming at me, saying I didn't know what I was doing. And it was because they were sharing the Excel spreadsheet and they corrupted the optimization programming in the background, okay? So you gotta be really super careful. So what I would do is I would pick a person within your team of 3 and say, okay, you're going to be the lead, on the passive portfolio. You're going to be the lead on the active portfolio. You're going to be the lead on the intrinsic valuation calculator that Dakota Armour built for you about a year and a half ago. The investment profit loss statement on the moving average crossover system. I'm going to teach you technical analysis. I'm going to teach you a moving average crossover system that basically looks at moving averages of stock prices over a 10, 30, and 50-day moving average period. And when the 10-day crosses the 50 and the 30-day crosses the 50, that's the buy or the sell signal. I will give you an initial 100 million, maybe $1 million to trade this strategy. This strategy is foolproof. It has never lost any money. Is that possible? Somebody's going to teach you a methodology based on technical analysis that's guaranteed that you make money. Any other professor taught you a methodology where you get guaranteed to make money? No? So what you do is you put a bunch of money into a 401k or a self-directed IRA. You start trading your stock portfolio in your retirement account because you're not going to pay any taxes on the gains when you're trading the securities until you reach 59 and a half and you start pulling the money out and you start paying income taxes on it. So it's a perfect environment of low trade costs and no capital gains taxes deferred until you turn 59 and a half. So it's awesome. And one of my students basically built a profit loss engine to basically calculate the profits on your trades over the 3-month period within the class. And every single student, every team, I gave them $1 million. They back tested the system over 3 years. The system made on $1 million, $300,000, or on average $100,000 a year, or 10%. 10% on top of the 10% of these. So you're looking at about 20%. So theoretically, you're doubling your money in 5 years, as opposed to 10.
So how rich are you?
Huh?
How rich are you?
Is that an appropriate question? Yeah, you be careful, unless you're a registered investment advisor. But these are the methodologies that I've used to build my wealth, and the methodologies that I've used to advise my clients on how to build wealth. I make money on assets under management. I make commissions. So I can make the money based off of this. And I'm in the process right now of developing a new product, okay, a new product based off of my research. And I will teach you my research. The midterm is my research. The research is my dissertation based on 25 years of experience. Based on indexation, how do you develop indexes? How do you develop financial products based off of the indexes to sell to retail clients and institutional investors? It's total application. I will teach you all of this stuff, and I will teach you the applications that I've learned over the last 25 years to not only build your wealth, but to go into employment positions and blow away the competition. Okay? Because usually graduate students have these tools. You don't have time. Okay? You want the tools now, right? Okay, so this is the profit loss based on the moving average. Then the financial ratios and valuations. Now, this is basically takes the 25 stocks that you picked here to build the passive strategy, and 25 stocks that you got historical data to calculate the covariances, to run through the optimizations, to trace out the efficient frontier. Then here is the moving average crossover system, which is the technical analysis. And then the intrinsic valuation calculator actually is a calculator for 25 stocks, and you put in your projections of the earnings per share, you set the discount rates, and it calculates the intrinsic values using perpetuity, Gordon growth multiple, and DCF. All in one engine that does it. And Dakota Armour programmed that himself over the semester. Isn't that amazing? So a lot of this product that you're actually using was designed by you, by your peers. Incredible. Incredible. It really is incredible. I mean, it's just the level of competency is just incredible that comes out of this school. And then here's an example of all of the products that you will be developing, that you will put into one of these deliverables over the semester, and this will be your final technical fundamental portfolio report. Now this report is probably worth $25 million. I'm serious. This is the stuff that's being produced within the companies. Okay, these things are worth millions of dollars. Do not give this to anybody. Okay, and if you do give it to somebody, you need a signed employment contract. Okay, with salary bonuses and other benefits. Okay, because I built this stuff, and to just give it away to somebody is ridiculous. I'm giving it to you. Okay, if you give it to anybody, I wouldn't give it to them. Okay, I would redact it or do something. But show them the level of quality of work that you can do, but don't give it to them. Monetize it for yourself, not for them, okay? Unless you get the contract, all right, and the bonuses. So this is basically the report. This is what Dan Keever put together for me. I thought that he was one of the best in producing the documentation, this is basically the documentation, okay, that you are going to replicate. So you already have the templates, okay? So now you got to do the research and do the work and put the information in there and then work with me to go through the material to give you the edits and the comments so that it's perfect, so that you can use the pieces of the booklet as examples of what you can do, okay? How am I doing on time?
19 minutes.
You're going to be doing homeworks. There's assigned homeworks. There's the solutions to the homeworks. Okay. Basically go, do the homeworks. There's going to be a bunch of websites that you're going to go to. Print out some pages to the website. Look around the website. I can't monitor you or baby you. I got to leave it up to you to do the work. Then print out the Excel spreadsheets and audit the Excel spreadsheets so you can see the formulas and how they're used to do the calculations for the option contracts or the yields to maturity on the bonds or durations or convexities. So they're all here. So I've assigned the homeworks, here are the solutions, look at the problems, look at the solutions, learn that stuff. Don't spend your time trying to figure it all out because I already gave it to you. Figure out the solutions, memorize it, move on. Okay? And then show me that you've moved through the material. Okay? I'm trying to get you through material, not bog you down and try to frustrate you. You know, I'm trying to grease the learning cogs, throw a ton of grease in there so that the wheel just spins at really high velocity, okay, so that you can blow away everybody, you know, in the process. Okay. Here's the chapter spreadsheets and templates. You may want to keep some of this stuff. You can totally download the whole folder and basically build an archive of Excel spreadsheets, PowerPoint presentations, reports for yourself. I'm giving you the tools and the resources for you to leverage as you go on in your careers. Okay? So here's all the Excel spreadsheets. Here's all the Excel spreadsheet solutions. Okay. Oh, and then some of my students, oops, sorry, I went too far. And then here are the PowerPoint presentations. For those of you, everybody, is going to be doing the PowerPoint presentations. Here's the base PowerPoint presentation deck that you're going to use. And what I would do is I would read the chapter, read the PowerPoint presentation, edit the PowerPoint presentation down, and add in some relevant information. Because the book is pretty out of date. Even though it's a current version, they don't use current stuff. They use historical stuff. If you can add in some current stuff, it just makes the presentation more interesting. Okay? If you do the presentation and you don't prepare for the presentation, and you're just reading from the slides, it's going to be extremely boring, and everybody's going to get all upset. Okay? They'll get upset because you're wasting their time. Okay? You're not teaching anything. They could have read the stuff. So really be thoughtful. Spend some time on the presentations. Put in some information. Take ownership of it, and then come and present it to us and teach us. Okay. Let's see what else. Oh, there's some chapter summary notes in here too that were taken directly from the instructor manual. So these are good things to start studying for your chapters too. Here's the investment portfolio template. Got it. Here's some historical lectures. Got it. And then during the midterm section of the class, as you're working on other stuff, what I'll do is I'll give you a crash course in real estate. Okay? Because they don't teach you any real estate, or they don't even teach you insurance. You want to become a wealth advisor, you got to know about annuities, and you got to know about insurance products. And insurance companies are the largest financial institutions with basically no leverage, and they're extremely innovative in their product innovation. But yet we don't even talk about it in our finance core curriculum. And real estate is one of the largest asset classes on a global basis. The U.S. Value of all real estate commercial is about $15 trillion. It's not as big as the stock market or the bond market, but it's a major asset class, and it's a major accumulator of wealth and distributor of wealth. And you start taking the real estate, and you start doing 1031 exchanges, and you start adding in tax strategies, Delaware statutory trust, deferred sales trust, tenants in common, maybe private annuity trust. You start adding in the tax strategies, now you're totally leveraging accumulating wealth. And then you throw it into an irrevocable trust and give it to your kids at a stepped-up basis. They pay nothing, no taxes. And if you slap life insurance policy on the principal, and when they pass away, all of the properties go to their heirs at a stepped-up basis, no taxes, and the insurance policy pays off the mortgage and all of the debt and all of the assets go to the heirs with no taxes and no debt. You want to be a tax person? Yeah. Tax is cool, because it's another layer of the engineering. Okay? And tax strategies are basically processes and products in their own right too, to basically put together the solution for your client, or the corporation, or whoever it is that you're advising. Okay? So you're going to be in a very competitive position. And if you do the tax route, along with an MBA from Wharton or Columbia or something like that, and you want to do investment banking or something, you're going to be a multimillionaire. Okay. So what else do I got here? So this is all the real estate stuff down here. This is all introduction to real estate here. These are all the real estate PowerPoint presentations. I have Excel spreadsheets for modeling purposes. If you want to get into it, download Excel spreadsheets. You can use them, I don't care. You have them in your pocket. And maybe if we have time, I'll go through some of the leverage, pre-tax, after-tax IRRs, unleveraged, levered IRRs, to kind of walk you through how us institutional investors analyze these real estate assets to put in our portfolios, either as a single account, a commingled fund, or to basically acquire these assets on behalf of the real estate investment trust, or the high net or the ultra net worth family office or accredited or qualified investors. Great. How am I doing on time? Okay, perfect. So this is all the real estate stuff down here. And again, I'll totally advise you on everything, career, whatever you need. But let's go back up to what are we going to do for Thursday? We're going to need to break up into teams and then be assigned the chapters for Thursday. It's the first step. You're going to monitor the markets, okay? And then also I need you to pull up and work with your team to design your portfolio strategy. You got to come up with a portfolio strategy. I want to do established company, high-tech, large cap, domestic portfolio. I want to diversify my tech portfolio between hardware, software, and social media and or marketplace, you know, eBay, stuff like that. So you have to come up with the 25 companies. You got to come up with the portfolio strategy. It's either going to be large cap, mid cap, small cap, large cap, mid cap, small cap allocation, maybe only large cap, maybe only mid cap. If you do small cap, most small caps haven't been around a long time, so they don't have 5 years of pricing data, so it's going to blow up the model a little bit. But again, you got to come up with a strategy. Are you targeting risk-averse investors, risky investors that are looking for yield, risk-averse investors that are looking for an 8 to 10% rate of return with a low standard deviation, with basically the portfolio segmented across sectors, maybe some risky sectors with some defensive sectors, and then picking the stocks that make up those sector allocations. So the first thing I'm going to ask you is, what is the portfolio strategy? Are you looking for return or risk-adjusted rates of return? Who are you targeting? Are you targeting retail investors, or are you targeting institutional investors? Do you have an allocation across market cap, large cap, small cap, large cap, mid cap, small cap? What is your industry allocations? And then what is your strategy? How would you market this portfolio strategy to an institutional client, a retail investor, and an investment committee to approve this for distribution? So really what you're doing in this class is you are developing product and process to present to the investment committee and the board of directors and senior level managers within a private public equity shop, investment bank, hedge fund, at that level. Here's our strategy. This is what we came up with. This is who we're targeting. This is how much we can raise. This is how much we're going to charge. This is how much we're going to make. And we go, do it. Go do it. So you're gonna build it, and then you're gonna present it, okay? You're gonna present it to us and convince us that your product should be made into an ETF, a mutual fund, a single account, that the strategy could be sold to ultra high net worth individuals that are risk neutral. And we can not only build a portfolio of the initial 25 stocks, but we can slap on a trading strategy using moving average crossover systems to yield enhance the strategy. We can do that too. So again, really creative, you know, in putting these things together. But the first thing you need to do is you need to go to this investment stock portfolio worksheet, pull it up. How much time do I have? Because I want to save the last 5 minutes for the team. 8? Okay. So pull it up. Here are the names of the top 25 companies. Don't forget to put your names up there. Here are the industries, and actually we segmented by the companies by the sectors, so we can get the sector percentages. We got the tickers right here, and we got the current stock price. Okay, and you're going to start with the that 10-year back test, 3-year back test. You're going to start with the master target portfolio, which is right here. So I got the names. These that might actually be linked. I tried to link everything to a master page, so you don't have to do it over again, right? So you make any changes anywhere, it's all linked. You got the current stock price right here. You've got over here, this is the total amount. We did $1 million here. If you want to do 10 million, you can do that, or 100, I don't care. But I started at $1 million. And then we used a scaling factor, okay? This is a smart beta product, okay? It's a factor model, okay? Factor tilt model. So what we did was we said, well, I could use market cap, or I could use EBITDA, or I could use revenues, or I can use some other factor to basically set the scaling factor. In this case, we used 2018 revenues for the company. So we went in, put it in, added them up, divided it back, and plotted the weights. Okay, then I got the weights. Right? And the target weights and the market cap weights are exactly the same. Okay? So now I got the weights. So this is a revenue weighted model. This could be a market cap weighted model. Total value of market cap of the debt and the equity, total value of just the equity, or the revenues. We used revenues. So we put in the revenues, added them up, divided them back, got the portfolio weights. Took 9% here for Apple, multiplied it by the million, gave me the value that we are going to initially invest in Apple. I took the value, divided it by the current stock price, gave me the number of shares. Okay? And then that gets set. So the only thing that changes over time in the future and in the back, once I get this thing set up, I basically go into the back test page and I go back, and since we're in January right now, I would go back to January of last year and put January stock price right there. And then I would go back to back test 3, and put in the stock price from 3 years ago. And then go back and put in the stock price from 5 years ago and 10 years ago. Okay? And what that's going to do is down here, what I did was we have calculated the average annual compound growth rate for the portfolio over the 10-year period. This portfolio averaged 13.4% per year over the last 10 years. Is that good? Yeah, you blew away your competition because the S&P 500 only did 7.4%. So you were able to provide 104 basis points of alpha for your portfolio over the last 10 years. Do you think anybody's going to give you money to put into this portfolio strategy? Yeah, the money's going to come pouring in because most managers can't even beat the S&P 500, and you blew it out of the water by 604 basis points. You're done. Money's going to start coming in. And the more assets under management we get on this strategy, we're going to get at least a point. So a point on what? A couple $1 billion? You're talking about some serious cash. Okay, that's how these guys think. Okay, and then back up here, what I would do is take the spreadsheet, go audit it, talk to your people, come up with a strategy, put the betas in here, right there for the individual stocks. And then what it does is it calculates a weighted average beta. So this portfolio not only gave me 604 basis points over the S&P 500 alpha, and my beta is less than 1. This is freaking water. They invented fire and water. It's amazing, right? That's freaking cool. This is the first thing you do, okay? And then there's a PowerPoint presentation that goes around this where you present it to us and convince us that we should give you the $20 million to build your portfolio management team and your trading team to basically launch this product and then distribute it and market through our marketing channels to institutional and retail investors. Do you understand? Where I'm trying to train you to think in the real world, not the book. The book is not going to teach you how to think like business people. Okay? That's my job. All right, so let's put the teams up there, figure out who's going to do the presentation on Thursday for the first 2 chapters. Come in. What I'll do on Thursday is I'll give out some problems. We'll practice the problems. We'll do the presentations, and I'll walk you through the spreadsheet again. And I would start thinking about your strategy. Yeah, you can take pictures of the memos and give the memos back to me. Give me back the products if anybody's interested in looking at the reports. You can look at the reports. If you want to look at any of the PowerPoint presentations around it, you can look at it. I also have on the website a whole series of technical securities analysis literature. If you want to become really good at portfolio fundamentals and technicals, it's all up there too.